Hello, hello. Welcome, everyone. God bless you. This is Denzel Rodriguez speaking, your personal finance geek of the 21st century. We are live. We are ready to go, ready to learn. If you're in the house, drop a comment. Let me know you're here. If it's your first time, this is your first live stream, let us know in the comments. We want to welcome you. Okay. If you have a specific question you need answered tonight, give me the opportunity to answer that for you, be as detailed as possible. I think it's only like 200 characters, so even if you have to comment, multiple times, if it's a paragraph, hey, the more details, the better, so that I can assist you the best way I can, or at least point you in the right direction, okay? Tonight, we are going to be talking about velocity banking and infinite banking combined, do some Q&A. So really, I don't really have a specific scenario to give you guys tonight. I've been working on some, but I really want to take this time to just try to answer as many questions as possible. So even if it has nothing to do with velocity or infinite banking, maybe it's kingdom stuff, maybe it's building a business, maybe it's credit, business credit, personal credit, maybe it's pre-game work to velocity banking, that snowball, you're in a particular position. I am dedicating at least a good hour, hour and a half to just simply answer your questions this evening. And then along the way, I'll share with you some things that I have going on in my business, okay? So let me take a look at some comments. All right, hello, this will be my first time seeing live, excited. I first saw you on a YouTube video on the Wealth Nation channel last week. Awesome. So I did a collaboration with Wealth Nation. That's Carmen and Darius. They have been really exploding over the last 6 to 9 months, a year. About a year now. They've just been like on a rocket ship. I think there are 60,000 plus subscribers at this point. I met them when they were at below 5K. So really nice relationship built with them. I collabed on their channel, then they came on mine. We've had a ton of fun with each other. We're gonna be doing some more collaborations, specifically with people who have life insurance policies already in place. And so Carmen and Darius and myself, we're gonna be coming together, putting out some good material and talking about, what happens after you have a policy in place. There's so much content about how to design the right policy, and it needs to be properly designed, and here are the dividend rates, and here are the loan rates, and here's the best company, and here are this option, here's this way, that way, this way. But there really isn't a whole lot of content about, okay, once I've picked the agent and I picked the company and I picked the product and I have it in place, then what? Is it just something I throw money at every single year, monthly, quarterly, semi, whenever I want? Or is there a strategy to this while I'm, building my wealth? What are some ways that I can use this while I'm trying to get out of debt or trying to start a business, finance a particular expense, whatever it is, right? So we're going to be talking a lot about that and really leading the way, because there really isn't a whole lot of real strategies, like going in depth, showing, what can I do with this thing once it's in place. If you're at that point where you're like, yeah, infinite banking is great, I love it, I want to do it, I'm learning it, but it's like, okay, once I have it in place, then what? So we're gonna be talking, about that, and that'll be a lot of fun. Shannon, hello, Key West in the house, cool. What does a HELOC? So is that what you're asking? What is a HELOC? So that's a home equity line of credit. Those come in first or second positions, and those are typically on personal resident property, but can also be on investment properties. You must have equity in your property according to what the specific bank requires. It could be, as low as 70 or 75% LTV, as high as I've seen 95 or even 100% LTV. So pretty interesting. Good product. Let me know if that was your actual question. Let's see, since it's opening of the baseball season, can we call it debt baseball just for today? Cool. Cool. Terry, hi all, hello. Melissa says, hi Denzel. How can I start velocity banking with no personal line of credit? I cannot get approved. Also, do you recommend term life insurance? Okay, so let's go to the drawing board. All right. So the question is, can I do velocity banking without a personal line of credit? So no debt tool, okay? No PLOC, no HELOC, no all-in-one loan, no life insurance policy. Can I do velocity banking? To a degree, yes, okay? And I could potentially do velocity banking with a credit card. If I do not have a credit card that I can use, then we are in pregame work. Or even if you do have a credit card, you're in the pregame of velocity banking. Nothing wrong with being in the pregame. You need to take the right steps. So pregame includes credit, right? So that means I need a strategy to build my credit score first, right? That's the main thing. So Melissa says I cannot get approved, so I'm assuming she applied and got denied. So if she applied, got denied, she shot herself in the foot, didn't do all her research, guess what? Credit score drops a little bit. Now I have an inquiry. So really the priority is right here. I would say building credit. And then the other priority would be cash flow, taking a look at your cash flow. And doing debt snowball or debt baseball, right? So is there certain debts that I can start just simply making extra payments with? In the meantime, those are typically the smaller debts, you know, credit cards, maybe a personal loan, maybe a card payment, certain hospital bills or collections, or what are some things that I can start getting rid of, right? Get my 4 major numbers in line: income, expense, debt, and cash flow. I need to know my numbers. So we got 3 things so far. I need to know my numbers. I need to know where every dollar is going. I need to establish discipline, right? This is what I'm doing. It's the preliminary pregame stuff. Second thing, take my extra cash flow, start throwing it at my smallest debts. I'm trying to build credit. And then I learn about building credit. Is it worth hiring somebody? You can work with my friend Brittany Green, clicking the link in the description below where it says, build your personal credit here, all right, or repair or fix your personal credit. So you have the option of hiring somebody or doing the work yourself by watching a lot of videos, okay? Maybe buy a DIY course on personal credit, which is a little more inexpensive, but it's more work. So that's the other priority. And you're essentially positioning your credit, your income, your cash flow to then reapply for a personal line of credit when the time comes. Okay? So yes, but not to its full extent. Right? You can't actually do velocity banking to its full extent until you have a personal line of credit or a HELOC or an all-in-one loan or cash value life insurance policy. That's when, the magic does occur. And then the second part of your question, term life, do you recommend it? Sure. Definitely. If I'm able to get, I pay if I'm able to pay $50 a month or something, and I'm able to get $250,000 or more, in death benefit for the time being, and I can afford it from my cash flow. It doesn't really hurt my four major numbers. Yeah, it wouldn't be so bad. Maybe it's a 10 year or 20 year or 30, whatever it is. I don't think it would hurt to have some protection if you have no protection. So if you have no protection whatsoever, you're at the pre-game stages, you don't have velocity banking implemented in yet, you've been maybe doing debt snowball, you're trying to get your numbers right, but you have a family, you have kids, husband, spouse, wife, and you're like, okay, I need some death benefit, because maybe you have a total of $300K of debt with no protection. At least maybe I can get some protection for the time being in case something happens to me on my, say, debt-free journey. I don't think that would hurt to have that. So that's a good question. That's a good question. I don't think it would hurt to have that. So term, there are, don't get sold into some high expensive term. There are some very affordable term life policies out there. Just do some extra research. If you go on YouTube, you'll see a lot of YouTubers with their links sending you to different locations where you can get really, really cheap term policies. And that helps. All right, next question. Says, thanks. Hello. What is the difference between a first position HELOC and a second position HELOC? Okay, so Fred's got a little confused on that. So we got HELOC. We got the first or second position. Okay, this is Fred's question. What's the difference? So let's say Fred has a mortgage at $300,000. Okay? That's the debt. That's what he owes. But the value of the property is $450,000. So that means, Fred, that you have $150K estimated in equity. There are a couple of ways, Fred, that you can obtain this equity. You can either do a common cash out refi, right? You can do a cash out refi where you get this $150, you now have a $450,000 mortgage at a lesser rate, similar payment maybe the payment goes up a little bit more, but now you have access to 150 grand that you can go do whatever it is that you want with it. Typically people will invest those dollars or maybe pay off debt or something like that. It's one option. The other is you don't refi and you get, let's say, a second position. So that means your HELOC is now in second place. So the mortgage is in first place. The HELOC is in second place. Let's say the bank was willing to give you 100 grand of a home equity line, revolving line of credit, right? So there's 100K at a different interest rate. So now you have the ability to pull from this 100 grand as you please at leisure whenever you want. You can pay it back whenever you want, right? As much as you want without any restrictions. And whatever you pay back, you can immediately pull back out again. So that's the revolving piece. It's open-ended for a period of time. So second position literally means that if you were to default, the mortgage company would get the property first. If the HELOC is with a different bank, that bank has to deal with the first position mortgage, okay? So that means the second position HELOC, if it's with a different bank or the same bank, they're taking on additional risk in the event you default. So that's why you'll hear stories about people's HELOCs getting frozen on them when markets tank, go down, or maybe they max out, they over leverage their 100 grand, and the bank will freeze it because you could be potentially over leveraging yourself, and they'll notice that, right? So that could be one of the drawbacks of a home equity line of credit. At any given time, the HELOC could freeze up on you. So that's why we practice, proper debt leveraging, not over leveraging ourselves, having a plan, strategic when we do velocity banking. So second, it's in second place. I have access to a certain amount of equity at any given time for a period of time. Once that period is over, it'll turn into a loan. The idea is by then we'd be debt free. So we don't really typically worry about that. Now, HELOC in the first position, Fred, is replacing the $300,000 amortized mortgage for a $300,000 simple interest line of credit. So it's like refinancing, but it costs less to refinance. So kind of like a cash out refi where you pull cash out of the property, you go do something with it. Now you have a new payment, lower interest rate typically. A regular refi is we renegotiate that $300,000 for a lower payment, lower interest rate. The HELOC is very similar to a refi, except it costs a hell of a lot less and can potentially get you out of debt a hell of a lot faster than a refi, right? Because a refi will go, the clock turns back, we go back up to 30 years again, whereas a HELOC is typically a 10-year or 5-year revolving period, and then a 10-year amortized, so it's actually a 20-year loan, essentially. But again, the idea with velocity banking is that we would be out of that debt within 5 to 7 years or less, pretty much before the revolving period is over, okay? So that is the difference. Now, what I'd like you guys to do is if I answer your question, say, thank you, you answered my question. If you're still confused, please type, hey, I'm still confused. Can you go over that again? And that'll help me understand if I actually served you or not. Okay. Are you able to write off a 6,000-pound car off the entire purchase if bought in December? So, I am not a CPA, but I have heard Grant Cardone talk a little bit about that, where there's a certain weight limit where you can practically write off an entire vehicle through your business if it weighs a certain amount. So these are typically like the trucks, heavy SUVs that weigh a certain amount. There's a certain piece in the tax code. Now, one person that I would recommend, okay, love this guy. His name is Mark J. Kohler. He's on YouTube. I'm pretty sure he will have a video on that question. He's a CPA. He's got a whole firm. Very educational. He's funny. He's entertaining. You'll really learn a lot. So Corey, that's for you. Okay. Fred says also you can refinance on a new vehicle for 5 years. Okay, so you must be answering somebody else. Karen says hello. Richard, hello everyone. Good evening. Denzel, what company out there is willing to work with an investment property with no mortgage and assign an AIO? What company out there is willing to work with an investment property? So are you saying the property's paid off? It's got no mortgage, so the property's paid off, and assign an AIO, an all-in-one loan? I would talk to CMG Financial. I'm not sure if you've reached out to them. That would be a good place to start. CMG Financial. You're in my course, I believe, with the manifesto. So there's a section in there, all-in-one loan. Check that out. The lady that I worked with, Heather, I left her information in there, so you could reach out to her, or you just type in CMG Financial. Get connected with a loan officer in your state, and I'm sure they can lead you in the right direction. If they can't help you, I'm sure they can point you to somebody that can. Cool. Melissa says, thank you for answering my question. Rich says, yes. Cool. All right. So we got 44 people in the house. I'm not seeing any other questions at the moment. So what I will talk about is in regards to the infinite banking concept in terms of funding. So a big question that people often get hooked up on is really, how much should I fund it? So how much should I fund a policy? Right? And let's say this is your first exposure to the infinite banking concept, to high cash value life insurance. What I want to do is share with you all of the options that exist in the marketplace. Whether you agree with it or disagree, it's good to know that, okay, here are the list of the options, and then I can do my research on my own time and navigate, eventually boil down to a specific product, and then I go find an agent that can help me, and then I try to find a company, an insurance company that I would like to work with, or maybe the agent can recommend, and I can do additional research and come to a conclusion. Yes? So let me first share with you the different options in regards to, this is a marketing term, infinite banking. When we say infinite banking or cash value or cash flow banking or become your own banker, tax-free banking, become your own banker, those are all marketing terms. These are the actual product names. These are the actual product names that you could type in and companies would pop up. But if you type in infinite banking, people will pop up, right? Articles will pop up, reviews will pop up. It's not an actual product. This is a concept. It's a concept. Here's the actual product that is tied to the concept, all right? So the actual products: whole life, index universal life, premium financing, investment grade insurance contract, IGIC, investment grade insurance contract, ILIT, irrevocable life insurance trust, okay? Irrevocable life insurance trust. All of these life insurance products right here are permanent policies. You'll have them for your whole entire life. When you pass away, the policy will terminate. Death benefit gets paid out to the heirs or the trust of the family, and then the funds get dispersed according to how you wanted it to be. Okay? So, whichever product you're looking at, no matter what, you got to know this, your four major numbers, so that you can come from an understanding that, okay, when I allocate this percentage of funds to this product, I know how I'm going to then use those dollars once I've established this particular account. So something that people get hooked up on a lot is right here. How much should I fund it? So they do all, you typically do all the research in learning the product and learning the concept, but not a whole lot of people talk about how much should I fund the policy? So for me, the way I did it for myself is I take my net positive, okay? We're going to write this out so it's crystal clear. Net positive monthly conservative cash flow. Net positive monthly conservative cash flow. Whatever that number is, let's say it's $1,000. $1,000 times it by 12. That's $12,000 a year. I then take that number and I will times it by 66%. Okay? Times 66%. And that's $7,920. Divide that by 12. That's $660 a month. So, conservatively, with my eyes closed, if I had $1,000 a month, let's say I got no debt, I have $1,000 a month, I have no debt, with my eyes closed, I could fund a policy either $660 a month or $7,920 a year. Consistently, conservatively, with my eyes closed. This is a conservative approach. The aggressive approach would be taking all your cash flow and dumping it into this type of account. Okay? But now here's the thing that you have to think about. If I'm an individual that has only $1,000 a month in cash flow and I have zero debt, or maybe I have debt, you need to ask yourself, is the $660 or the $1,000 a month, putting it into this concept, this idea, is that the best use of my dollars according to where you are at financially? So, in my opinion, because this is my opinion, at the end of the day, you're free to do whatever you want. But if I was in this position where maybe I'm only making $4,500 a month, my expenses are $35,000, I got zero debt, and I'm only cash flowing $1,000 at the end of the month, me personally, I would not start a policy right away. Right? My objective would be, how do I take that 10 grand? How do I take that 1,000 and turn it into 10,000? Right? So essentially, how do I 10x? First, because out of all these strategies right here, there is no way I'm 10xing my dollars over here. What you need to understand is this product, all of these products are long-term products. So it's long-term growth, right? It's safe for the most part. These products are, for the most part, safe. Long-term growth. So if I only have $1,000 a month, I make $4,500, I spend $35,000, you want to really ask yourself, before I look at this, is there a way I can take that 1,000, turn it into 10? Or better yet, is there a way I can move the comma 1 over and add a 0? Is there a way I can go from $4,500 a month to $45,000 a month so that I can have more conservative monthly cash flow to work with? And then dump a good amount of money over here into this safe place. Okay? Another way that I will figure out how much an individual that wants to fund a policy is I'm going to look at what you're already doing in your finances. Are you saving? Right? Are you saving consistently? Are you giving consistently? Are you investing consistently? Right? Are you saving? Are you giving? Are you investing? What is it? Is it like a 10%, 10%, 10%? Is that how you roll? Is it 10, 20, 15? What is it, right? So I try to see what are you already doing. And essentially I could take the saving and the giving and probably even the investing dollars, add them up all together and come up with a solid funding amount. Because one could say, all right, if I got 30% of my monthly income, that's free cash flow. And prior to coming across this concept, this idea, I was saving 10%, I was giving 10%, and I was investing 10% each and every month. Well, I could take the 30 as a whole, max fund a policy, and redirect where you save and how you give, right? Just redirect it to the policy, and then essentially you'd be borrowing the 10% out to invest, and then throughout the year you're pulling roughly 10% out to give, right? So depending on what that number actually is and what it boils down to, how much cash do I start out with, right, will determine if that makes sense. But really at the end of the day, we're looking at this. Cash flow is the most important thing, and I'm also looking at your capital. Do you already have a certain amount of savings already built up? Do you have a certain amount of investment already built up? Oh, maybe there's an investment that you no longer want to invest in. Let's say it's a 401k. Let's say you finally come to the conclusion that 401ks are terrible. You hate them. They've been charging you ridiculous interest rates, fees. You found out you're going to pay higher taxes when you take withdrawals out when you're older. You found out that the fees are calculated annually. So that means that every single year, whether it's a 1% fee, a 2% fee, or 3% fee, that number doubles every single year for the most part because it charges you on an annual basis on all of the money that's in there, not just the principal dollars. It charges you on the growth and all. Even if the money goes down, even if you lose money, you still get charged a same annual fee on all the money. So even if you lost money, you still got to pay a fee for losing money that year. That kind of sucks. So if you came to that conclusion, you're like, oh man, I don't like this no more. And maybe you were allocating $1,000 a month. So that's, say, 12 grand, right? And then you were allocating $600 a month to your savings account, which was earning you 0%. So you weren't earning anything anyways. So let's say that's $7,200. And then you give the same amount. You give $7,200 a year or something like that. So now 7,200 plus 7,200 plus 12,000, you're all the way at 26,400, and that's not including any additional capital or cash flow, right? Savings is not cash flow. Saving is an expense. Giving is an expense. Investing is an expense. So if you're saving $1,000, you're giving $1,000, you're investing $1,000, you cannot add that to your cash flow. So you'd have to minus that. You have to record that as an expense. Then what's left over, free cash flow, money that doesn't go anywhere, maybe that number is $800. So if it's 800, that's 12, so that's 96, right? You see how we can get higher and higher in terms of like what we could fund, and then in no time, maybe we're in 30K a year, maybe we're 50K, maybe 100, maybe $250,000, maybe $500,000, maybe $1 million. Really, you can go as high as you want in terms of funding. You can go as high as you want according to your age, health, and finances, right? So what you can't do is, if you only make $4,500 a month, you can't say, oh, I want to put in $100,000 a year into a policy. They won't let you do that. It has to be proportionate to what you bring in, what your income is, you know, and then your age and health will also determine how much death benefit they're willing to give you. Okay? So that is one of the biggest questions that I often get. People get tangled up with that, and I try to simplify it as much as possible. It really just boils down to your monthly cash flow, your existing capital that you do have, right? And then your comfort level, right? Because you might say in your head, well, okay, if I put 30 grand over here and the money is, you know, for long-term safe growth, well, maybe I have an opportunity to put this 30 grand in a real estate investment deal where within 6 to 9 months I could flip my money and make 10 grand on the 30. You're not going to make 10 grand in any one of these products in the first year. No way. Every single product right here in the first year, you're negative, right? So you put 30K in, you're not going to have 30K to start. Nowhere near 30K to start or to actually use, right? So maybe in your head, you're like, wait a minute. I have 30K. Maybe I can go invest in my friend's business and we could flip this money in about a year and double our return within a year, 30 to 60K. That's not bad at all. I'd rather you do that and then have the 60K and then come back to me and then give me 30 or 20 to help you design a policy. Because now you're securing your profits. You're saying, okay, what you did first was you established a money-making machine. This is one of the biggest problems I think a lot of my clients and viewers face, which is you haven't taken the time to establish a money-making machine. What you've been told by financial advisors, people like myself, is to, hey, get out of debt, build your credit, save, right? Save your money, or invest your money, but in Wall Street. Invest your money outside of you. Invest your money in Bitcoin. Invest your money in gold and silver, in oil, and all these different things that's outside of you, which is great. Nothing wrong with that. I think it has to do with timing. I think everything is in timing. Is it the right timing? So if I'm dealing with a client that, like I said, $4,500 a month, is it the right timing if they're debt-free to say, yeah, take that extra $1,000 and, you know, put $500 a month towards, you know, a whole life policy, and take $100 here and save it in your bank account. Take another $100, put it in Bitcoin, another $100, put in gold and silver, another $200 buy the S&P 500 index, and, you know, pursue your financial independence and retire early movement. I mean, that's cool and all, but did we establish a money-making machine that you build, you personally? And a money-making machine gets built off of your personal gifts, talents, and skills. Yes? Your gifts, talents, and skills. What gifts, what talents, what skills do you bring to the marketplace to increase this. Too many people are focused on this growth when you need to be doing this, multiply. Because if you multiply, it's so easy to grow. It's so easy to grow because now you have the problem of, oh shoot, I'm making 45 grand a month. I'm still living the same lifestyle. Maybe my expenses went up to 10, if that, and I'm cash flowing freaking $30,000 a month. So now you got a new problem. You cash flow 30 grand, right? 30,000 times 12. You're cash flowing $360K a year. You don't know where to allocate the money. That's a better problem to have than to only be dealing with 1,000 and thinking that, you know, with these policies and this and the gold and the Bitcoin and the silver and the yada yada and the Roths and the this account and the index is going to do anything for me in a short period of time. It may. I'm not saying it won't, but I'm betting my cards on multiplication. I think I can beat anybody in math if I multiply versus somebody who grows their money at a measly 8 to 10% or lower nowadays, much lower. Right? If you're growing at a steady 4 to 6, 8%, wow, good for you. But why not multiply? 1 plus 1, 2, 4, 8, 16. That's a lot faster to me. You multiply that 30 times, you're at $1 million in no time. And then you take the free cash flow. Boom, get the policy, buy the Bitcoin, buy the gold, buy the silver. Now you're diversifying, buy the index, buy some real estate. But what is the money-making machine, right? That's the biggest thing. When you're figuring out, oh, you know, how do I time this infinite banking thing? You know, I'm getting old. Well, if you're getting old, why not build a money-making machine? You've been on planet Earth for 40, 50, 60 years. Why not build a money-making machine first? You have 30, 40, 50 years of experience on planet Earth. There's got to be something that you're an expert on, right? There's got to be something that you know very well because you've been on planet Earth for 30, 40, 50, 60, 70 years. If you still don't have a money-making machine, what's going on, right? So that's my little rant. Let's take a look at some questions. Let's see if you guys put any more questions in here. Okay, so we left off. Good evening, Denzel. What is your opinion of the index participation feature of a whole life policy? Okay. So, the only company that I know that offers this is Guardian. The only life insurance company I know that has the index participation. Oh my God, I can't spell. Index participation. Yep, there we go. Rider. All right. So IPR for short. So not with IULs, there's an index. That's really the main difference between a whole life and an IUL, right? You got that index rider. So not including those, because that is the product. I think your question is more so on the index participation rider feature on a whole life. Correct me if I'm wrong, but if I'm right, the only company I know that offers that is Guardian. And so the way theirs works is there is a 2% flat fee. Your cap rate is 12.5%, and it follows the index, I believe the S&P 500 if I'm not mistaken. So let's use my policy. So I'm funding $70K a year, $7K is my premium. I am approaching my 3rd year. So at this point, I got about 130 plus thousand in cash value. And then when I dump in the next 70K this year, that number will go up close to the neighborhood of probably 180, 190, probably more. So let's say I wanted to allocate 50K to the index rider. So I would pay 2% flat. All right, so take your 50 grand, times it by 2%. So I pay my $1,000. That's the fee. Boom. Let's say the S&P goes down, negative. So because there's that 2% flat charge in the beginning, let me make sure I got my numbers right. Yeah. So the Guardian has that 4% guaranteed floor, right, that they're going to credit us. So that means I've got 49,000 actually working in the index. But let's say it goes negative, I'll still receive 2% growth that year on the 49. I paid my 2 from the 50, paid the flat fee, but it did not earn, right? The S&P went negative, but I still participate in the guarantees of that insurance company, which is 4%. But since there was a 2% fee, you minus it, your net internal rate should be 2% on the 49. That's how that works. Let me know if I answered the question. If you are more so talking about the IUL and their index, that's standard. You know, every IUL has an index, and there's different options, obviously, within IUL as well. All right, Corey says, thank you. Would you explain how to read the tabular value sheet? Not too good at that. Here's a good resource. If you go to IBC Global, if you type that in on YouTube, Steve Parisi provides a buttload of videos where he provides really, really good illustrations explaining the charts, the columns, all that. What I can do is I can take a shot at it. So give me a second here. What I'm going to do is I'm going to go on my computer here, see if I can pull up my policy and try to read it to you guys. So let's see. I actually don't think I have it on this computer. I have to go to my email. So let me go to my email. So bear with me a second. So let's do this. I'm going to keep some questions going while I look for that. Okay, so you're saying on a whole life? Yeah, so we'll get to that. What is the oldest age you can start a whole life insurance policy if you are healthy with no pre-existing conditions? So far, the oldest client I have is right at 70, 71. But if you go here, IBC Global Inc., type that in on YouTube, and he will be able to answer that question. He's done some videos on how old is too old for this kind of product? How old is too old? All right, so if you're in your mid-50s, this isn't a worry for you, okay? If you're in your mid-50s, no pre-existing health issues, you're fine. This live got recommended to me. Cool. Why not just start a policy and use the policy to 10x and set up a new policy for the additional income later? So the reason why I would not do that is because, again, like you're saying, take money, take my cash flow, throw it in an account that's going to be negative the first few years. So that means I have a limited amount of funds, right? So let's use the example of, 12,000. So the scoop says 12K, right? Let's say we got 12K, throw it into a whole life, right? Maybe you do a 90-10 split, right? Base premium, $1,200, and you've got your term cost, you got your PUA cost, you got your sales load cost, right? You got all this cost in the policy. Maybe you have a starting cash value between 9 to 10K, maybe, in the first year. Let's go with the lower number, call it 9K. Times that by 90%, you really can only borrow, about 8K and some change. So you gave 12K, you can only use 8, right? And if you borrow all the 8, it's not exactly the best thing to do. When I talk to my clients, I usually only tell them borrow out 66%, because you don't want that loan interest to cause a drag on the performance of the policy, because the dividends are not guaranteed. Okay, only that guaranteed floor of 4% is. And with the loan interest rate, if the policy doesn't perform, if you're with an IUL, that could be an issue, right? So we want to be careful. So I usually, borrow about 66. So take 9K times it by 66%. A more reasonable amount of money to borrow out of a 12K would probably be about 6. So you went from 12 to about 6 to 8K. I mean, you know how much it costs to start a business and run and operate a business? There's a lot of fees that a lot of people don't know about. You're going to hit a lot of roadblocks along the way. I don't know about you, but I would want to have every possible dollar at my disposal if I'm going to 10x. If I'm going to 10x my income, see, I think people misunderstand, like, what exactly does 10x mean? Like, do you know how extremely difficult it is to go from making $4,500 a month to $45,000 a month? It's extremely difficult. There's a lot of work, there's a lot of commitment, there's a lot of effort, there's a lot of pain, there's a lot of challenges and obstacles and trauma and fear and worry and doubt. I can go on, okay? It's not easy. So you don't want to be delayed by any means, right? You don't want to be delayed by any means. So that's why I try to be practical. I try to meet people where they're at, and try to say, listen, do you have it in you to do this? If not, all right, play it safe. Do you? But if you have it in you to 10x, even if you failed and got 50% of the way there, that's roughly 20K a month, I don't think you'd be upset. Even if you failed and got 30% of the way there, I don't think you'd be upset. That's $13,500 a month, right? So that's the point. And if it took you, say, 2 or 3 years to get there, and you used all your resources to get there, when you go and start this thing, you're going to be light years ahead of the dude that took his 12 in the beginning and only had 6 to use, and now he's, strapped to a big bill. And what happens if COVID hits, a COVID 2.0 or another crash, and then I lose my job? And that can be a little difficult. So that's why I would rather not. Fred says, thank you, Denzel, for the HELOC explanation. Still have questions, but we'll save my questions for later. Ask your questions. Now's the time. Ask your question. Can you wire funds from whole life to a brokerage? Not that I know of. When it comes to sending money from your whole life policy, it goes to a checking account. And then from there, you send it to your brokerage account. Why not just lay claim to all the securities? No, don't save it. Don't save the debt, spend it, get rid of the hot potato. There is no money, it's all debt. I hear what you're saying, I like it. Yep, your gifts, talents, skills, labor, energy plus credit. You are the credit. Cool. Yes, sir, you are correct. I'm not referring to the IUL. Thank you for answering my question. Thank you, thank you. So yeah, if you have a question, right, please be detailed. Ask your question, put it in the comment, and if I answer it, be sure to say, thank you for answering my question, so I know that we're on the same page, okay? That's all I ask. Why not just bring both sides of the ledger to a balance of 0 like the banks and courts do by the end of the day? Okay, you're speaking smart to me. Get a little more practical. There's some people in here like myself that, aren't that educated. So get a little practical with us. Talk in English to me when you say that. Let's see. Use it as a high-powered savings account. Cool. Why not enter into your proper, you're saying why not enter. You're saying a lot of why nots. You got to give me one thing. Why not enter into your proper role of beneficiary or title holder of your, okay, we got a smart guy in the house, of your foundational security and use your securities intermediary. Trust to handle your debt. Trustee to handle your debt. Credit must return to source and debt must return to source. I am the source of the credit. Interesting stuff. Again, you got to speak English. Break it down. Make it simple. Given the level of difficulty to 10x, it seems locking in the guarantees on a policy would still be a good conservative move. I just don't think it is an either or question. Thanks for your reply. Good to know. I appreciate that, right? I appreciate that. So what Scoop is saying is, hey, this 10x thing is not easy. I mean, what is easy in life, right? So now it becomes a mindset battle. That's what it really boils down to, right? It boils down to a mindset battle. Either I tell myself that 10x is hard, just like I just said it to you all. It's not easy. We can all agree 10xing our income is not an easy task. But then again, nothing in life is easy. Giving birth, marriage, building a business, working, going to school, getting a high degree, a doctorate, a PhD, a JD, a bachelor's, a master's, discovering a cure. What is easy? Life is not easy, right? So if we have an understanding that nothing is really easy, you either have a skill, a gift, or a talent that when you apply yourself to a thing, it may come off as, oh, that was easy, or that was, achievable, or pretty simple to do. That wasn't too bad. It could be because you have a gift, skill, or a talent for that particular task, so it comes easier to you. It's like somebody that writes well. Well, I think everybody can write for the most part. Some people write better than others. So it becomes a mindset battle where I have this assumption that I say 10x is difficult. Got it. I believe you. But does it stop you from actually pursuing the difficulty? Does it stop you from trying to achieve the task? And then you create a scenario in your brain, oh, let me just go with the guarantee. Or let me just be safe and save my money here and buy a little Bitcoin here and buy a little gold and silver here and buy a little bit of this and a little bit of that, right? And let me just play it safe. Let me get my Roth and my 401k and let me just keep being safe. I mean, hey, it might work. I just don't know many 65-year-olds, many 70-year-olds that took that path and can honestly tell me that they're living the best life, that they're living a life worth living. I don't know really any 60-plus-year-old individual that went that pathway, the three-legged stool, the pension, the 401k, or the Roth, whatever it is, the savings, whatever financial strategies they were given, right? I have not personally met anyone over the age of 60 that is living their best life. The only people that I've communicated with that are living their best life are people who 10x'd, right? People who started a business, right? And people who created value in the marketplace and got paid for it at an exponential rate. So that's something to really think on, really think on. You know, how do I want to play this, man? How do I want to play this game of life? Okay, all whole life and the loans can be paid with a credit card? No. You cannot pay a loan on your cash value policy with a credit card. Can't do that. That won't work. And if you do, it might cost you money. I'll look at the IBC Global after this live chat. Yep. How something the board would look if you add cryptocurrencies. Be a little more specific. What do you mean? When doing velocity banking, it's better to tackle the small debt that costs most in terms of percentage, but in terms of actual dollar. Okay. With the right level of research and education about cryptocurrencies, they can be a powerful force in any financial plan. Totally agree. I agree. So what I don't want you guys thinking is that I'm against any of the financial products that exist out there, because I own them all. I have them. You know, I got a Roth. I have a HSA. I have a cash value policy. I have cryptocurrencies, gold, silver, Bitcoin, Ethereum, Cardano, stable coins. I got the stuff. But how did I get the stuff is what I'm trying to say. And I didn't get it through just having a job, right? It's a job plus starting a business, creating a money-making machine to fund everything, to fund it all. And I live broke on purpose, right? So I'm just following, you know, my good old Uncle G. That's all I'm following here. You know, so you pick a financial strategy, a financial concept, a way of living. I mean, this is one of the most fantastic things that I learned from Grant, which was, he says to save 40% of your income. How is that possible? Right? He says save 40%. The other 40% is for taxes. You're going to set that aside, and you're going to live off 20% of your income. He's like, the only way to achieve this is to increase this income. It's impossible to live off 40% of your income if you only make. It's impossible to save 40% and live off 20% if you only make $5,000 a month in the U.S. It just ain't going to happen, right? With living and rents and costs of goods going up day by day, it's not duplicatable, it's not reasonable. You know, it's not the most ideal thing. But it becomes very doable when you just add a zero to your overall income. Just add a zero. I see 10x as a goal to shoot for, even if you fail miserably and only 2x your way, you're way ahead of where you were. And that's absolutely true, right? It's a matter of thinking big, expanding your ability to think big. And even if you fail and got halfway there, 20% of the way there, 30% of the way there, you would not be upset, promise you, right? Because it takes you a lot longer to try and invest your $1,000 a month or your $2,000 a month or your $3,000 a month. It takes a whole lot longer to invest those dollars in these financial products, these other products, than it is to take your $1,000, put it into yourself, and make $10,000 from your $1,000. It's a lot simpler. It's an easier strategy. There's a process to that. I think it works a lot faster. That's just me. Okay, we got Oregon in the house. Alan says you can use a security-backed line of credit. The only potential downside of that is that typically 30 to 50% of the limit was available, and if the market drops, you can be subject to margin call. Interesting comment. Appreciate that. Thanks for dropping value. Let me see something real quick. So I'm trying to pull up my policy so you guys can, because I know one of the questions earlier was about the, how to read the columns, right? So, trying to pull up my policy. Give me 1 second. And if you got more questions, keep typing them in. More questions come in, keep typing them. Okay. All right. So, I'm going to share my screen. Let me go like this. Camera, share screen, bam. Okay. Let me know if you guys can you guys see my screen? I just want to make sure that you can see it nicely. All right. That looks good, right? Yeah. Cool. Let me just get a thumbs up. Yes, you can see it nice and clear. I zoomed in on it. I just want to double check. Cool, cool. All right, so the question earlier, let me think, let me see. Question earlier was how to read the columns, right? Cool. So let's just go left to right, right? So you got the policy year. That just represents how many years I've had the policy. So technically speaking, I've had this policy for 2 years. And I'm about to approach, this is when the policy got started, all right, 2019, at the age of 23. Based on the current illustration, we're not a mech. It's a good thing, right? So 2021, my 3rd year. 25, I'm currently 25 years old. Here's my base premium, $7,000 bucks. Here's the guaranteed cash value. That's what that says. End of year dividend, 2,644. So in addition to the 7 and the 7, boom, I get 9, and I get additional dividend. These are guarantees, okay? Net premium. So premium means total, right? So there's base policy premium, 7 grand, but then my total premium is 70K a year. That's how much I'm putting total per year into the policy, right? This column says cash value of all ADDS. That stands for additions. So that 193,474 is the amount of death benefit my cash value obtained me. The 2 payments of 70K. That's how much I got. Total face amount. Face amount's referring to term life. So I got 1.3 million from that. Oh no, sorry. Total face amount of addition, yeah, 1.3, and then okay, face amount of 1 year term. That's the real term, right? Of the 1.8. So when I first started the policy, you can see how it's a little bit higher. The what happens in this specific design is that the term rider starts to fall off year to year, and then this column is representing not only what my cash value purchased me, but also like the base premium as well is included. So total face amount of PUAs, additions, right? 900,000. Net cash value. Oh, so I was wrong. I said earlier that my policy would be at like 180, 190. According to this, I'll be at 203 by the 3rd year. That's pretty cool. So I have a level death benefit for the first 7 years. As long as I pay 70K straight, no issues, straightforward. My term will fall off after the 7th year. My death benefit would go down if I never pay in another dollar again, but that won't be the case. I'll continue to fund it, right? So net cash value shows the estimated amount that this money is going to grow year over year, not guaranteed. Only this number is guaranteed. But these numbers is based off just the 7, right? And these numbers, this column, is based off the other cash, you know, the other monies that went into the PUAs right here. So this and this, we get over here, boom, right? And then, you know, if all I did was just pay in 70K for 7 years, it's $490,000, my money would have broke even, right? I break even, and my money grows forever. It's an ever-increasing tax-free personal line of credit that I can tap into, right? So at 58, I'm at 2 million cash. So would you say I did okay? I think so. Death benefit continues to grow, right? Let's say Denzel passes away at a good old 90, you know? Good old 90 years old. Get 9 million. Maybe I take out a loan at 90 for $4 million, and I throw a big party at 90. Right? And then I drop dead. So that would mean that the insurance company would just minus the 4 from the 9 plus any interest, and then the rest comes back to me, you know? If I live to 100, I'm at 11 million. So for 490 grand, I can end up with $11 million. Not bad, right? Right, well, in reality, if I kept paying the base, you know, if I kept paying the base, it would actually be a lot more in reality. Because this is me putting in 70, and then to keep the policy active, right? To keep the policy open, active, the insurance policy itself becomes sustainable, where from my dividends, 7,000 goes to the base. But then the money still grows in a positive upward direction. But if I was to continue personally putting in 7 grand, these numbers would be a lot higher, you know, they would get better with time. So I don't know if I did a good job in terms of explaining the columns. It can be quite confusing, but like I said, I recommend looking at IBC Global when you're ready. You know, you talk to an agent, mention my name, Denzel, and they're more than happy to help, provide value. Okay, so we got another question here. Let me come back up. All right, so why do you think there's a lot of criticism of the 90-10 split of premium/PUA from many established IBC practitioners? It is a direct, I would say, conflict. It's a direct conflict to the IBC practitioner's pocketbook, right? It's a direct conflict to that, right? It affects their commissions greatly, right? So you just saw my policy. If I would have went with, say, a 50-50 split, right? So 70,000 times 50%, 35,000 bucks goes towards premium. You know, the 35,000 goes towards cash value, right? You still have the term rider, still have PUA fees, sales load charges. The commission on that, let's say it's 80%. So I'm going to make roughly $30,000+ on that one policy, as opposed to if the premium was $7,000, right? So 50-50, 90-10. If it was $7,000, times that by 80%, it's only $6,000 bucks, $6,000 and some change is what I would make on my own policy, is $6,000 as opposed to $30,000+. So, you know, it's a direct conflict to their pocketbook. The other reason why a 90-10 gets criticized quite a bit is the fact that if you don't inform the client, right? So let's say you did the same exact policy as me, 70K for 7 years, right? As a 90-10 split or 10-90 split. Either way you say it, we get what you're saying, right? But let's say after the 7th year, you want to put in another 70K in year 8, in the 8th year. Well, with a 90-10 split, you would not be able to do that, right? So that's a drawback that we can identify, is say, oh, well, if I desire to do a policy for long funding, a long funding period, say 30 years, 40 years, then a 90-10 would not work. It would not work. We'd have to go at least, 30, 40 years long with Guardian. We'd have to go up to maybe like 75-25 split. The advantage to this is that you have the ability to put in 70,000 for more years. So that would mean that if you were to compare somebody that puts in 70K for 7 years up against somebody that puts 70K for 30 years, even though the 90-10 is going to have more cash in the early years, eventually the person that puts in 70K for 30 years is going to blow past the 90-10 split because they're putting in more money. So you as a client, you as a potential client, you need to really know, how long am I willing to commit these dollars to this type of account? How long am I willing to commit? How good is my discipline when it comes to money? Because what you don't want to do is design a 75-25 or even, as high as a 60-40, or, I would never go past 60-40 personally, but, I do see a lot of 50-50 splits. If you do that and you give them 70 grand, and then in the 7th year or the 8th year, you're like, I don't want to pay this anymore, or maybe you can't afford it, right? That's a worst case scenario. What's the worst case scenario? You can't afford it. You're not able to keep up with the what? Premiums. If you're not able to keep up with the premiums, now it becomes a big bill. Now the strategy is no longer working so well. So what happens? People cancel policies. And then they're left with what? Surrender values. And those have charges. So you really end up in the hole if you don't keep to your word, so to speak. So that's where the 90-10 kind of comes in and says, look, you don't have to commit to a long funding period and still have high cash value and long-term high cash value. What you are able to do after the 7th year is put in the base plus maybe 3x the base premium for the rest of the policy's lifespan, and that's cool too. So those are some, really good things to know as you're really looking into this. Yeah, so Prince says because it doesn't yield enough commission, pull it out. That's one of the main things. Oregon, yeah, the 10 of what the agent's commission is based on, 4x commission. Yep, looks good. Clear. Thanks, guys. Appreciate it. Okay. I think that everyone should take first chunk of substantial gains or earnings and put them into a trust. Setting up a back office as trustee, also start future entities in the trust structure. Yeah, so you're saying if I get a big windfall of cash, absolutely, I agree with that. I would definitely, the trust, the will, estate planning, I would start building a team. I'd want a lawyer, a CPA, a business coach, a life coach, a mindset coach. I would start building a team around myself if I do fall into a windfall of cash, for sure. I agree with that. Agent commission is a factor, but not the sole factor. I'm curious about the impact or potential downside long term. Not worried about MEC with 90-10 splits. Yeah, so he says, I'm curious about the impact or potential downside long term. So yeah, I think we identified what would be a drawback on the 90-10 is that you wouldn't be able to continue to max fund your 70K. So if you do 70K for 14 years, I think you could probably still get a 90-10, 70K for 20, maybe 25 and up, you're gonna be required, you need a higher base premium, which is because we need a higher death benefit to be able to put in all that extra money. So how are you supposed to pay off college loans effectively? Okay, I would like a little bit more detail with that question. That'd be great, Evan. So how are you supposed to pay off college loans effectively? Well, effectively, that's a good word, right? Well, you have the options. What are the options to pay off debt? Debt snowball, debt avalanche, velocity banking, infinite banking, velocity banking, infinite banking together, debt snowball, velocity banking together, or the one above all, 10x. 10x your income. Build a business, sell something, get a side hustle, make more money. That's really what 10x is, make more money. If you have a PUA but passed away with extra cash value, the insurance company gets the excess, ? And if underpaid, family gets the paid difference, question mark. All right, let me see if I understand this. So if you have a paid up addition, so you're saying, well, here's what you need to know, is every time $1 goes into cash value, you'll probably average about $3 in additional death benefit, right? So let's look at my policy again, right? So let's say I pass away at 73. It says my death benefit is 6.3 million. I have a living benefit of $4 million, right? So if I die with no loans outstanding on the policy, I get 6 million. I put 490,000 in, I get 6.3 million back. I'm not going to get 6.3 plus 4 million because technically the 4 million is in here, the 6.3. That's where that's at. My cash value is a living benefit, which comes from my death benefit. So that's why every time we take out a loan, a cash value loan, our death benefit gets minused from the cash value. So therefore, our cash value continues to grow as if we never touched it in the first place. All right, so I'm not sure if I answered the question there or provided some clarity. You can help me with that. But I don't know. That's a tougher question. But from my understanding, every time a dollar passes through into cash value, not only is it earning, but it's also buying more death benefit. And that death benefit continues to increase according to the dividends and the performance of the policy. So whether I die with loans or without loans, the only thing I get is a death benefit. The cash value is the death benefit in a sense, because I get this working dollar today, but then it multiplied itself in the death benefit, and that's why we end up with more than what we ever put in to the policy. Okay, not the sole factor, but the biggest factor. A higher base will get higher dividends, but the actual growth in the policy is less unless dividend percentages increase a lot in the future. Okay, most common answer example I hear to your question is the selling home example. When you sell a home, you get market value regardless of how much equity you have gained through payments. Yep. Cool. What vehicle would somebody older or with pre-existing conditions just starting use to replicate this system? Maybe they can use somebody who's younger. Maybe they have a younger spouse. Maybe they have children, brother, sister that's younger. So you can use another person to establish, a policy, and then you are the owner, they're the insured, you're in charge of the cash. This is what banks and corporations do on their top executives. So you could low-key do that in your household. Tim says, thank you. Okay. Could be put one potential drawback I see is that when a policy matures and returns the most value for each dollar, your ability to contribute could be severely hampered. Yes, there you go. Depends on the carrier. With Guardian, we are limited in how many years we can stretch that design, but Mass Mutual can stretch that design as long as you want to pay in. That is also true. But the issue with, even with a 90-10, right? So now Guardian will not allow us to do a 90-10 forever, but with Mass Mutual, we can get close to a 90-10. It might be like 85-15 depending on your age, health, and finances. But with Mass Mutual, you could do, say, 70K for a really long period of time. Like I'm funding a policy, 15K for 31 years, and it is a 90-10, right? So my base premium is $1,500. The term rider stays on though that whole entire time. So it doesn't drop off. So that cost does go up, but when you look at the net return, although my cost continues to technically increase in the Mass Mutual design because I'm holding on to that term, the net underlying internal rate of return continues to, grow pretty substantially. So if you were to compare, say, a 60-40 against a 90-10, same funding, period of time and all that stuff, I've seen quite a bit where the 90-10 comes out on top and the 60-40 is like right there, so that's the other thing is there's not a big difference. So if 90-10 is right here, 60-40 is like right there. And if you go on that YouTube channel, right, you type in IBC Global, I erased it earlier, but you type in IBC Global Inc., he's done plenty of illustrations where he shows a 90-10 and a 60-40 right up against each other, same funding amount, same age, same health, same funding period. The only difference is 90-10, 60-40, and when they're at the end, like 30 years later, 40 years later, the cash value difference is not so far apart. It's not that far apart. The advantage of the 90-10 is we get that short-term high cash value usage. So that means I can take more money out early on and go do something with it and, make quite a bit of money. I'm going to take a quick break here. Give me 1 second. Drink a sip of water. All right. I had to take a little sip of water there. Cool. Penn Mutual also, but the design possible is really 80-20, really good returns though. Yep. Good insights. Yes, thank you on the question. Cool. How are you not getting more views, bro? Jose Flores. Correct me if I'm mistaken. Did you once say that you can skip velocity banking with a line of credit card, and just use the whole life high cash value policy? Yes. So I guess a good example would be somebody that makes a lot of money. Maybe somebody that has a lot of capital. So I would say to skip velocity banking using a HELOC or a credit card, typically that person has high income, capital, right? And it doesn't mean that they're not going to still use velocity bank, because they can do both, right? But it does kind of put velocity banking kind of off to the side, and they can take a lump sum of cash and start a policy right away. So I have a client that, dumped about $250K into a policy, right? And then he, borrows out, and he's essentially moving property debt into his policy. So instead of using a debt tool, line of credit, he's establishing a big policy that he's going to fund over, a decent period of time, and he's going to gradually, shift, move debt, use it to invest and things like that. So I would say those people typically will overlook velocity banking, but they don't completely ignore it. They'll still get their credit cards, and they'll still get HELOCs and all-in-one loans. They'll still use them because they're great. Or they'll use 0%, business loans, or 1%, 2%, 3% business loans. You go wherever you can save the most amount of interest, right? Great explanations as usual, Denzel. Good stream. Thank you. Wife and I sold all 401k positions. Use that to fund first year up to MEC. Interesting. Interesting. Good move. Cool. Good to know. Good to know. So we are hour and a half in. Are there any other questions? I'm going to give you about a 20, 30-second warning now. Last and final questions, and we're going to wrap up. Hope this was really helpful. Kind of expand your mindset here. Okay, he's talking 10x, he's talking velocity, he's talking infinite. You know, bringing it all together, forming a strategy to move forward, right? Let's see. In many IBC Gold videos, they state dividends are more favorable to base premium versus PUA. They have shown example numbers, but not the math behind the favorable numbers. Secret sauce math question mark. So it's a factual statement, you know. I would say any infinite banking practitioner, whether they're doing 60-40 split or 90-10 or 80-20 or anything in between, we all life insurance agents will agree that the base premium dollars are more favorable in terms of dividends. So they're stronger than the dividends on the PUAs, the cash, right? So that's a pretty big argument that some agents will use to encourage you to have a higher base, because you're getting a higher, you know, technically a higher return. But it really boils down to this. Here's how you want to think about it. Let's use the same 70K, right? If I'm putting in 70K a year, my base premium is $7,000, but your base premium was, let's do a 60-40. 70K times 40%, 28K, right? Here's what it really boils down to is the 70K with a 7K base or $28,000 base, they both have the same MEC limit. That's the crazy part. So what you'll see is they'll typically have the same MEC limit, because that $28,000 is whole life premium. That purchases you less death benefit. So in this one has more of a term, which is buying more death benefit. Same amount of death benefit, pretty much similar MEC limit. So the real question to ask is, well, if it's possible to put in 10x my base and I'm doing 70K and you give me a 28K base premium, what if, oh, my stomach's going crazy. What if I do 70K with my base premium at 28,000, but my MEC limit is 280K or more, right? If it's 280,000 or more, that's a hell of a lot better than the 90-10. I'm going to go with this one. But if you're giving me the same MEC limit for the same cost, for a higher cost, same MEC, that doesn't make sense to me. Because if the whole intent is to put as much money as we possibly can into these things, then why not give me a higher MEC for lesser costs? You know, especially with the new rules coming out, that's how it's going to be. The MEC limits are going to be higher for less, you know, cost essentially, right? Let me take another sip of water here. Whew, my throat's getting dry. Sorry, guys. So, that was a good question. I just saw a bunch of other questions come in, so let me get to them. Super hopeful, thanks. First year, 17,000 cash value. Second year, 33. Can I borrow 15 the first year and about 30 the second? without paying back nothing or not? I don't know how on earth you're going to have $15,000 to borrow if you put $17K. I don't know how that's possible, right? That the math doesn't make sense there. So I'm going to stop you there because I don't know any policy where I can put in $17K and be able to borrow $15 the first year. I don't see how that is possible. So I'm going to stop you right there. Even on a 90-10, you ain't going to have that much cash value available to borrow. You have to remember, your most expensive years are in the beginning years, right? The beginning years. Most expensive years are the beginning years. Could you explain to me the meaning of a Roth IRA? Sure. Pretty simple. It's, what is it, post-tax? Is that right? Y'all correct me if I'm wrong. It's after-tax dollars. No. Yes. I'm not mistaken. Oh my God, why am I getting confused on here? I think the max, is it $6,500 a year now? Somebody correct me if I'm wrong on the Roth. I think it's $6,500 or $6,000 a year that you can contribute. You can pretty much invest that wherever you want, for the most part, in the marketplace, stocks, right? Bonds, mutual funds, ETFs, options, whatever you want. And it grows tax-free. Right? You pay taxes now on that $6,500. Pay taxes now. The money grows tax-free. So you don't get a deduction on the 65 you enter in because you're going to pay tax now on it. Grows tax-free. And then when you get to a certain age, tax-free income. Right. If you get to a certain high income, there's something called the backdoor Roth, and there's a way to, play around with that. Denzel, I don't have any credit card debt. I just have my mortgage. Would it make sense to utilize my HELOC to pay off my mortgage? Probably. We have to look at the numbers. Right? So let's say you got a HELOC at 6% and your mortgage is at 2.2%, or it's at 2.7, or it's at 3. It might not make sense to do velocity banking on that. It might not. It might not make sense to try and pay that off early at all. Because if your mortgage rate is less than 3% and your property is appreciating at 3%, you might want to ask yourself, do I really want to pay this off? Do I really want to allocate my cash flow to pay that off? Or can I take that cash flow and earn a higher rate somewhere else, or invest in my business, or 10x, or acquire another property, or turn that property into an asset where it pays me cash flow? Maybe I rent it out. So there's a lot of things to consider. Currently have a 15-year fix with a 1.75 rate. He says, I do want to pay off my mortgage sooner. Okay. Well, it's up to you. If you want to pay it off, cool, do it. But 1.75, if your HELOC is like 4 points higher, it might not make sense. That's where we say, okay, we ran the numbers. Velocity banking doesn't make sense. Well, you're left with that snowball. That's it. Grace and peace to you in the name of Jesus Christ. Amen. You bring tremendous value to your kingdom. I'd be remiss if I didn't express my thanks for the great financial education you provide. Thank you, Joey. Appreciate that. Should I pay my mortgage down to get a HELOC before I start an IBC policy if my monthly cash flow is under $1,000? Probably. Depends. Got to look at your numbers. You got to see what direction do I want to go in. How valuable am I propping up IBC, right? How valuable am I really, mapping it out on the timeline. If I got under $1,000 in cash flow per month, yeah, let's do some velocity banking. Maybe how long is it take me to pay off that mortgage? Should I pay off that mortgage? Should I even look at the mortgage? If that's the only debt I have left, I did velocity banking, wiped out all the other stuff, right? We wiped out all the other debts, and now we're just left with your mortgage, maybe student loans. Maybe now's the time to create a 10x strategy, create another stream of income. And you want to do the math. If it takes you the same amount of time to 10x to get debt free, if it takes you 5 years to get debt free, it takes you 5 years to 10x, which would you rather do? Because you have to understand, if you 10x in 5 years or less, you could just write a check, pay off the whole mortgage, right? So you both got the same goal. The difference is the person that just did debt snowball or velocity banking is debt free and broke. They have to start the engine. They now have to invest. Whereas the other person took the time to 10x, managed their debt, got to the end line, wrote a check, paid off in full, and have money to splurge and keep reinvesting in themselves. So there's a lot to look at. Thank you for the education. Can you talk about why index life would be a better, can you talk about why IUL would be a better infinite banking tool than a whole life insurance? I heard some advisors say only whole life and not IUL. I would take a look at Oregon Cashflow Pro. Okay, he was in the house earlier, probably still is. I take a look at his material. He provides, pretty transparent information. I would say whole life is probably going to give you higher cash value in the beginning. IUL is more hypothetical. You're not getting the guarantees that maybe the whole life provides. Okay, so with the IUL, you're now flirting with investing because your money's going in the index. It can grow, it can lose, it can go up, it can go down. So the way I've been pitched IUL and explained IUL to me is more of a retirement strategy. So the idea that you're going to have more money than a whole life at retirement age, right? So it's kind of pitched that way in that sense. Good to hear your comparisons on 60/40, 90/10, listen to some Banking with Life of podcasts. They are entertaining but seem to think they know everything about proper infinite banking. How much does VGLI convert to and give most retired soldiers at 20 years? It's a good question. I don't know that. 15K out of 17K is 88%. Guardian, you can get 87, so it could be close. Yeah, that's good. I appreciate that. So Oregon's saying, could maybe be done, but again, I just don't like, personally, I don't like to borrow the max amount of cash in the first year. There is a way to get to 90% available to borrow from Guardian. Also, I can share it with you sometime. Yep. I believe it. I just don't go anywhere near 90% leverage on my policy, because there's a component of saving also in infinite banking that we kind of want to stick with. I think a lot of us, and I probably made the same mistake, is, infinite banking, the concept, it really shouldn't be intertwined with investing. I think the main idea is safe, guaranteed growth. That's like the main idea of the concept. Safe, guaranteed growth, recapture costs, recapture interest. Savings is the biggest key behind it. And then it allows you to redeploy that cash into an investment outside of the policy, earning money in two different locations. So But there's so many strategies on the internet where, yeah, infinite banking, and I've done it myself, I pull it, could be used as a way to invest your dollars where you send the money to it first, then you borrow it out and you go use it. That's fine and dandy. But you really need to take the time, just sit down with someone, take a friend, take a partner, evaluate these people, evaluate myself, people on the internet that I recommend. Just look at all the options. You come to a decision. I don't think you will go wrong if you know this right here, your 4 major numbers. You can't go wrong if you know your 4 major numbers. So say, for example, you did get a 60-40 split policy, right, with a whole life. And then you come across someone like myself that does 90-10. Well, if you knew your numbers, you got your 60-40 whole life, great, keep it, keep funding it. Maybe you had it for 7 years. It's well established. You're well past the cost. Great, cool, keep funding it. If you come to me, I'm going to say, look, let's build that. And if you want to start a second policy, okay, maybe you do a 90-10. And then after coming across me, then you come across IUL. And so you're like, oh, shoot, I want to try that. I want to try IUL. I say, okay, well, how do we keep increasing this income? And then you can feed into the IUL. And then you're like, oh, shoot, what's this premium financing thing? The bank can fund my own policy. Okay, hey, how do we keep increasing income? Maybe you get a premium financing policy. I've seen people do it all, where they get them all. Because I guess you won't know until you try, right? In that sense, I will say, me personally, I dwell right here for right now. I got 2 whole life policies, have a Roth, have a Robinhood account, Fidelity. I do the stocks, I do the indexes, I buy the S&P. I'm more interested in real estate, putting my money in real estate. Okay. I buy the gold, I buy the silver, the Bitcoin, the Ethereum, the stable coins, the Cardano, the altcoins. I'm just essentially, the more I focus on this, building more income, the more financial products I can purchase and leverage and use. So the issue never becomes the product, really. The major issue is this, the money. Do I have the money to afford it? Right? So that's why people with such little cash flow, if you've got little cash flow, $1,000, $2,000, $3,000, if that's the only money you got, that's why you're spending so much time trying to say, oh, is this better? Is this better? Is that better? Is this better? Is that better? Is this better? Is that better? Is that better? Is this better? This, You spend all that time trying to find the best product, but your biggest issue was this. You don't have enough money. So you're trying to get the most, right, out of those dollars, because if you lose it, you're in deep you know what. And we don't want to be in deep you know what. So that's why I like when I talk to my clients and I just meet them where they're at. I'm like, look, here's where I want to go. I understand that you don't have the knowledge yet, or you don't have the mental capacity to handle this yet. I get it. But at some point, we cannot just make sense of cash flowing $1,000 forever, $2,000 forever, $3,000 forever, and save and invest those dollars outside of ourselves for 40 years and hope and pray that these financial instruments are going to provide us financial freedom. I don't think we should look at it that way. I think we should look at how can I bring value into the marketplace and get paid at an exponential rate and have more money to put into the financial instruments, and I basically guarantee financial freedom in that sense. So those are my thoughts. And we are going to wrap it up. Still 100 people in the house. Love it. Or let me see how many people now. It says 97 people. Wonderful. You guys have fun this evening? Is it good? So let me share with you a couple things that are going on. So tomorrow morning, we're going to be talking about increasing your income in 2021. I'm doing a little test. I'm going to go live on Facebook and YouTube at the same time. I'm testing it out. I finally figured out how to do it through my all these products that I buy with the Ecamm Live and stuff. So we're going to try that out tomorrow morning. What is that? 10 a.m. Eastern Time. I will be going live 10 a.m. Eastern Time. So you'll want to tune in. Okay? And y'all can help me out. Y'all can support. And we're just going to talk about ways, all the different ways that we can increase our income. And I want you guys to bring value, mention the ways that you're increasing your income in 2021 and how that can impact lives, okay? And then we got another live stream April 8th, 9 p.m. Eastern Time, Velocity Banking Fundamentals. I'll bring a real life case study there so that we can, work through the numbers and see if it's a right fit for you. Okay. Let me see. Vanessa, Sherry, bravo, thanks, cool. Denzel, I need your help. Do you provide personal consultations? So thank you for asking that. So yes, I do offer personal financial consulting only in the Velocity Banking Manifesto. So you have to join my program first, okay? So I have three options. I have a monthly option, $19.99 a month, $19.99 a month. I've got an annual option, $147 a year. I've got a lifetime option, $547 one time. It comes with 1 hour session with me, one-on-one. And then with all the options, the monthly, the annual, the lifetime, I have something called performance-based consulting, performance-based coaching, performance-based coaching. Messing up my words there. So with that, you have to go through my course, watch the videos, and you will earn time with me one-on-one, which you can redeem at a later time. Okay? So if you're looking for an instant conversation, one-on-one, right away, the lifetime option is going to be better. Although you'll get a message from me where I say I highly recommend that you watch my videos, go through the course, get your numbers in line, get your debt tool, learn the fundamentals so that I'm not teaching you the same stuff that I share in my videos. We go right into the strategy, right? Consulting is for strategy, right? I don't want to really coach you on discipline and why this and why that and why this and why that. I don't really want to do all that. I want to strategize numbers in 1 hour or less. Here are your numbers. This is what you're doing. Here's where you got to make the chunk. Here's where we make our next chunk. Here's the money that we got to redirect. Like, it's straight to the point. That's how I like to personally operate. I will leave you with that. I left out some comments, so forgive me, but we're going to close it out here. Thank you for tuning in. God bless you guys. Enjoy the rest of your evening. Click the links in the description below so that you can see all the different services, the different options in terms of working with me, working with my partners and affiliates, and then also joining my email newsletter so you stay up to date with all the events that I have going on, getting access into my private Facebook group so that you can ask more questions over there. I have a lot of my clients and loyal subscribers that give value in the comment section where people post their numbers, their questions, very detailed. And not just myself, but there's a whole community of people that are giving value. So that's pretty cool. And I will leave you with that. Talk soon. I want to bring to you helpful tools and tips that you can use and implement in your life. So you have to define these words for yourself so you can understand how you can proceed in life in terms of making money. Work means becoming a king. That's what work means to me. But it's up to you to actually put in the work so you can see where you're at, what you're doing. This way you can see what you're up against and how to tackle it. Learn your purpose in life so that you can fulfill it and help others do the same. That's like my personal mission.